Who would want to become an automatic millionaire? Of course, there's no magic to it, Steve, but you can set it up automatically to set yourself up for success.
Sounds like a good plan to me. But yeah, the devil is in the detail a little bit on that one. But
Yep.
it's very important when you want to get on the path to financial freedom, as we lay out in the book, to set up an automatic investment plan. And it's pretty simple, right? You can do it in 3 steps. Obviously, the most important is probably the one that we harp on the most, but is most critical, is have a budget. How much are you going to be setting aside every month? Is it going to be, or every paycheck, whatever it is? Is it $100, $200, $500, whatever it is? Hopefully, you can have 20% of your income be able to go to this automatic investment plan, but that also includes 401ks and things along those
Right.
lines. So setting that up is critical. And then next is setting up an account, right?
I'm sure most people, back in the day when you'd write the check out for your utility company and mail the check in, and that took a process, and maybe payments weren't made on time. But I'm pretty confident that once they came up with automatic payments for your utility bill and everything else in our lives, very rarely do you ever miss a payment as long as there's funding there. So it does work, obviously, when it
Right.
comes to bill pay. And it makes it easy too, right? I mean, the days when we would actually mail in our utility bills, it was like a process of collecting those every month. But automatic makes it easier, as long as there's funds in the account, of course. But also just to set it. I mean, to be able to put it on cruise control. I mean, we talk about it in the book, and have your game plan automatically implemented each and every month or every 2 weeks or whenever you want to pull funds out. And, a lot of younger people are like, well, where should I start, Mark? After they read the book, I'm like, open an account, go online, open an account, get it funded, get it started. And then I do believe it becomes habitual that you start seeing the account building. Let's just say it's $50 a month or $50 every 2 weeks or whatever the number is just to get the snowball started.
Hmm. Yeah, and where to open up an account,
Yeah.
as we talk about in the book, there's a lot more specifics that people can read about or maybe have read about in the book. But just from a high level overview here, we're talking about a brokerage, right? So open like a Charles Schwab, a Fidelity, doesn't
Right.
cost anything to set that up in terms of having an account with them. But what that does is allows you to have not only the money move into that account, but be able to set the automatic investment in terms of what you want to invest in. So maybe before we get to that step, so let's just say you open it up at Fidelity or Schwab or a similar company like
Right.
that. Once you have that account number, then you just need to work with your bank and get into the weeds a little bit here, as you talked about, figure out when is a good time for that money to go. So if you all of a sudden get paid on the 15th and 30th of the month, then
Mhm.
maybe you want to do it on the 17th or something like that. As we talk about time and time again, when the money is sort of out of sight, out of mind, it's a greater chance that people are going to stick to it. And then if you make it automatic on top of that, it sort of just snowballs in terms of a positive thing, in terms of being able to get the money into that account and then
Yep.
invested from there, right?
Exactly. And if it's the more the mid to long term money over the next 2, 3, 4, 5 years, and depend on your risk tolerance. Of course, we've always got to have the disclaimer out, Steve, that everyone's risk tolerance is a little bit different. But in general, a lot of times we're seeing where people want to invest in something that kind of looks like the S&P 500, very well diversified, and there's so many different.
What maybe talk about that for a second. What so people hear probably about the S&P 500, they see the ticker,
Yeah.
on the news and stuff like that. What is the S&P 500?
So you look at the S&P 500, of course, you look at the Dow Jones as well. So you get the Dow 30, which is just a representation of what 30 stocks are doing at any given time. Then the S&P 500 is more of a broad-based index, kind of a gauge of what about 500 companies are doing. So you can't invest directly into an index, but there are exchange traded funds and mutual funds that try to outperform those 500 companies on average. And so it's a little bit more of a diversified account. There's risk associated with investing, of course. And so a lot of times you can pick like an ETF like the SPY, for example. So Google SPY and kind of do your homework on that. Not that that's a recommendation by no means, but it kind of gives you an ETF way to get allocated in the market without actually having to go in and select all the different stocks in your portfolio, which is something I do believe that it empowers investors when they know what they're invested in. So, a lot of times with younger people, we'll start with a handful of stocks that you're going to buy this stock, this stock, this stock, this stock, and those stocks show up on your statement and they build upon that. So they want to know what's in their portfolio. So it depends on your level of transparency, your level of risk tolerance of how you invest. But I really encourage people that even if, and we're not recommending this, even if you just put the money into a money market that earns barely anything, you're doing the most important thing for yourself. You're saving the money. That's a huge step. And I think a lot of times, Steve, people get hung up on what they're going to invest in. They feel like they're going to make a mistake, but just save the money. Save the money, and with time and with confidence, you'll get an allocation that you're comfortable with.
Yeah, start a process. In terms of once you start that process, maybe you do start with the money market where it's going to be super safe and all that. And then over time, you're like, okay, well, this isn't as bad as I thought. And then to your point, the S&P 500, I know a lot of times I'll get questions on that in terms of like, I don't know what the S&P 500 is. The way you described it is perfect. You're actually buying a little bit of Apple, a little bit of Amazon, a little bit of these companies. You actually are a shareholder in kind of an indirect way, I guess, of all those stocks. So as they go up, your portfolio is going to go up. If they go down, they're going to go down. But the chances, as we talk about in the book, nothing's guaranteed for sure. But the chance of the S&P 500 going bankrupt or going zero would basically be the equivalent of all approximately 500 companies going bankrupt, which is pretty.
Same time.
Yeah, exactly. At the same time. Yeah, which is pretty rare. I know it's never been done before, but you never know in terms of what's going on. And the other thing that I think is worth noting too is that what we're generally talking about here and is very detailed in the book is these are funds in your bucket 3, right? So these are funds that are 5 years out into the future. So if you can get yourself on a regular cadence of investing, that's going to help you out down the line dramatically. But if the stock market goes up a little bit, stock market goes down, doesn't really matter because hopefully the stock market goes up because what you own is going to go up. But if stock market goes down, then you're buying at a discount, right? You're buying the exact same shares and everything like that. You're just getting more of them, right? I know that's kind of a change of mindset for most consumers, but I know you try to talk to your clients about that all the time. If the stock market's going down, that's not necessarily a bad thing because you don't need that money for 5, 10, 20 years down the line.
Right. And as you know, if you're adding to it every 2 weeks or every month and the markets do go down, to your point, Steve, you're potentially buying lower. It's like the pair of slacks that you've always wanted are now on sale, or the shoes that you want are on sale. In this industry, this is probably the only industry where fear comes out when the market goes down, which in theory, obviously, being a long-term investor, you want to buy low and ideally someday sell at a higher valuation. But it does. It's just your emotions do take over. And so having a consistent game plan and doing a little bit of homework on where the markets have been, not that the history repeats itself, but it does rhyme a lot, and kind of be an educated investor to a certain point. But again, to your point, don't get hung up. But even on a money market account, there's risk. With a CD, there's risk. Probably less risk than individual stock. But in life, there's always going to be a risk associated with what you do. So, but the most important thing, the best thing you do for yourself is actually have a plan and actually get that money committed for down the road.
Yep. Great conversation today, Mark. Set it and forget it. I think that's the takeaway here. So
thanks, Steve.
Good talking with you.